Let's go to last night's budget and the lasting economic impact of it. The key forecasts are that debt will continue to rise, that interest rates will rise also from mid-year until 2024, that inflation will rise, then fall, and that key commodity prices will ease from their near current record levels. Let's pull all of that in the mixer with one of Australia's most prominent economists, Westpac's chief economist, Bill Evans. Bill, thanks so much for your time. And first off, does the government's extra spending in the budget create more inflation and therefore make interest rates move higher and or for longer?
Oh, Ross, look, I think that's very much overstated. The two initiatives that will happen this financial year, the fuel excise and the $250 payments, that's only 0.12% of GDP. Look, it's not a big number. Central banks have always stayed away from fiscal policy in terms of its impact on monetary policy. I don't think that's going to be in any way change the Reserve Bank's attitude, which is one of patience at this stage.
OK, but then the budget does certainly indicate that money markets and the budget therefore is predicated on rates starting to rise from the middle of this year and likely to continue with rate rises until 2024. How does that correlate with your own forecasts?
Ross, I think that they'll start raising rates in August. I really don't think that the patient approach will be taken away for the next couple of months until we start to see some more evidence on inflation and some more evidence on wages. But then they'll start to move, and I think there'll be 3 hikes this year to get the rate to 0.75 and then another 4 next year with a peak of 1.75%. When you look at the exposure that the household sector has to debt at the moment, 1.75% will really create quite a slowing in the economy, and I think it'll achieve the Reserve Bank's objectives. But this is all in the context, Ross, that the markets are now expecting that peak to be 3.5%. They're expecting the Reserve Bank to start raising rates in May and go every meeting to the end of the year. So it's quite an extraordinary difference between myself and the markets at this stage. I think in all my time in the markets, I've never seen such a difference of opinion. I think we'll be right and they'll be wrong this time.
OK, so you've often been right. I will actually make that point to other people as well. But one other thing is also about the management of the debt. Getting to over $1 trillion, you don't see any sort of budget repair to the point where you get surpluses any time out into the future. And so the debt continues to rise. Is that manageable, especially with those rising interest rates?
Well, I guess the thing that bothered me the most was in 25-26, spending as a proportion of GDP will still be 26.3%. And the average before COVID was 24.9%. So we haven't even got back to the pre-COVID levels. And that's after 4 or 5 years of a much improved economy. That's the big challenge. That's the structural deficit that the government needs to deal with but wasn't able to do in terms of getting that spending down. Having said that, at least the gross debt to GDP ratio, which was expected to be 50% of GDP peak in 28-29, has now come to 46% in 24-25. So that's progress, but we certainly haven't seen that progress on the spending side that we want to see to get those numbers down more quickly.
I'll tell you what, it's going to be fascinating to watch it. And Bill Evans, Chief Economist of Westpac, always great to get your input here on the program.
Thanks, Ross.